Good morning, Oak Bloke here, and we're going to cover ESO, which is, well, ticker ESO, and this is it's an idea I've spoken about before, and if you have a look at past articles, one of its holdings is Luceco, so that's been covered. So originally covered this back in 2024, so about two years ago now. And in the last 2 years, I mean, you could have bought it 2 years ago and it wouldn't have moved very much. Um, so you might quite reasonably say, well, 2 years later, excuse me, what frog in the throat. Um, why are you still banging that same old drum, Oak Bloke? Well, okay, let's think why. So look, back here, the, perhaps one of the key reasons I was interested in this was its just degree of discount to its NAV, but also the potential of its holdings. Now, I think it's fair to say that I did say that these would be companies that you're buying for the long term, that this isn't like a short term trading opportunity. 2 years later, well, you could be buying it for the long term, and you could be buying it as a trading opportunity. And this video hopefully will cover why. So look, the trading update from ESO, trading statement. Um, so one of my readers um, messaged me and said, "Oh, do you realise that ESO have reported a 10% increase?" Oh, sorry, down here. Oh, sorry, my cursor seems to be. Oh, I don't know why that's not allowing me to highlight but you sort of see this. I'll point to it with my arrow because well, I don't know why that's not working. But anyway, a 10% increase to NAV. Um, and to be fair, I sort of was aware of it actually, and the thing that I thought was particularly interesting, though, was that when you actually factored in that post period, so the NAV was taken by about here. So if we go back a month, so the 31st was sort of here at, well, let's say it was 160 a share. So ESO owns a large chunk of Luceco. Post period, it's Luceco has grown even further by about 10%. So yes, I was aware of it, and it was I suppose partly because I'd read the Luceco trading update, seen the increase in the share price, and noticed that ESO had not moved in share price along with it. And I thought, well, here we go again, because 2 years ago, if you go back to my prior articles, one of the things I was pointing out is, well, ESO is so cheap relative to Luceco is that when you actually buy one share of ESO, you get kind of X pence worth of Luceco shares. Well, the reality was that you could buy a Luceco share for £1.75, or you could buy an ESO share for £1.80, and you get £1.75's worth of Luceco because it's such a large component of the company. And just to explain, so Luceco, so ESO owns 22.12% of Luceco, so largest single shareholder, and of that, the ESO fund owns 80% of that 22.12%, which is which at the NAV 31st of the 10th looked like that, yeah, 45 million. So that kind of was the £3.60 there, or well, it looks like there's a tuppence out, but at today's £1.75. Basically, what we can see is there's about 15 pence that has been added. So actually, it's not just up 10%; it's up more because of Luceco being up more. Okay, so that's yeah. I mean, I've been adding to ESO as a result. So, I mean, let's get into the details of this article. So I've called it fueling up with, excuse me, fueling up with ESO. You have to forgive me. I'm absolutely fine, and then I start talking, and there's frogs appear in my throat. So anyway, and just to explain this, the ticker is ESO. It's known as the EPE. So it's the EPE Special Opportunities Limited Fund, and then Epic is the well, yeah. So it sort of gets interchangeably called three things. I think Epic is the fund manager within this. So yeah, it's all, it sort of has sort of several names, I guess, which is why I've called that there. And inside it, it owns several holdings. So we'll get into what those are. But yeah, we can see the NAV has jumped by about 10%, but post period has jumped by more. And we can see back here, it was well in excess of £5 and had grown from £2 to £5 in a relatively short space of time. But obviously, post this 2021 high, it sort of dropped quite substantially, and has sort of been quite flat ever since. I mean, arguably has dropped a bit more, maybe. Obviously, had a bit of recovery and dropped a bit more. So it's sort of a like, you don't immediately look at this and go, "Oh yes, wow," because it kind of looks like it's you know flat, not very exciting. But down here is what you can buy it for, and up here is what it's worth. And let's have a look at what it's worth and what the items are within it. So um, I guess I guess Luceco itself, when you look at the trading update for Luceco, is probably the first thing to say. Sorry, my mouse has jumped. Let's get into here. So just before I do though, in terms of its debts, it owes 4 million as in terms of loans, and then it has a preference share, which is this ESOZ, which you could also buy. It's a listed holding, and you could buy that. Well, 2 years ago, I did point out to people, if you want a low risk um, holding, which is ahead of the ordinary shares. So, and because it's backed by so many assets, I mean, it would have to be I think I described it as a Montgomery Brewster style destruction of value in order to not get your money back. It's nice to, I mean, and these mature later this year. It's nice to see that this, what you could have bought £1.04, is now £1.25. So you would have made 20%, an easy 20% at very low risk, just under two years. I mean, this was March 2024, so just under 2 years ago. I mean, if you bought it today, it's going to be realized at 129.16. So there is still a bit of upside. If you bought it at 125, you'd get something like 3% over the next 10 months, which, I mean, at this point, given the portfolio and the cash position and everything else, I mean, again, it's sort of almost impossible. Again, Montgomery Brewster style, a catastrophe would sort of mean that you lost out on that. But yeah, I mean, obviously the upside is not as good as 20% 2 years ago. Yeah, that just thought I'd mention that quickly. So getting into this, so it's sort of well, I sort of said 56, but 55-56% discount based on Luceco's share price today of £1.75, and the buy price for ESO, which is £1.80. It had cash at year end of 14 million. So I mean, if it's recommenced buyback, so if you actually bought back shares at £1.80, the discount would grow to 63% once that buyback program had completed. And then I go on to say, well, if you sold off all the Luceco shares at today's Luceco's share price and then bought back the shares from the proceeds of that, you'd end up at 102% discount. So when I sort of say, the Luceco share price means that it's essentially what this ESO means is that you're buying the rest of ESO, excluding cash, excluding Luceco, for free. I mean, it's back at that point where you literally are buying Whittard's, Pharmacy to You, which includes Lloyd's Direct, Rayware, and Denzel's, or part of Denzel's, all for free. Which, in my opinion, I mean, none of this is advice, and you make your own investment decisions, but I just think that's incredible. And let's get into the detail of, um, and in any case, Luceco itself, I think that's got further to run. I don't see that that is now at a high point, which it can't go higher from here. In terms of forecasts, the upside, according to ShareScope, says target of £2. These are broker guesses, but that's kind of what and they're looking at what, a 7% increase to EPS. So it's not going to necessarily double, double or triple or something like that, but when you look at the EV chargers, for example, um, those are, sales of those are up 85% year on year. And the point I would make, and I made in this article, is that it's not even just about whether you believe electric vehicles are going to be successful, although they are still growing as a ratio, as a proportion of UK vehicles. A larger number of people are choosing electric vehicles, although the increase has slowed down. The point I would make is that the Chinese, particularly, you're probably seeing new brands on the road, brands like BYD, and trying to think the other one I saw the other day, Chongdu or something. Um, but yeah, there's several out there. JQ as well. So brands that look as good as the best of Europe, look to be premium brands. And I've driven one. I mean, I drove a Lincoln Go. Now, this wasn't an electric vehicle; it was a mild hybrid. No, sorry, it wasn't. It was a plug-in hybrid. When I went on holiday to Spain last September, and I've driven BMWs, Audis, Mercedes. In fact, I regularly hire any one of those three brands when I travel and go abroad. And this time I had a Lincoln Go, and I thought, oh, this isn't a German mark. But honestly, after driving it and experiencing it, driving it for a week, we did a sort of fly drive holiday, I guess. It it's as good, if not better, than German. I mean, because if nothing else, the buy price on them is substantially cheaper, um, and also the just the equipment levels, and you just wouldn't know that it wasn't a German premium brand. I know I've talked about this before, but it's therefore the case that EV chargers, when you are seeing penetration of electric vehicles at a 20 to 30,000 pound price point, that you are going to see greater penetration. That's just the days of the 80, 90,000 pound Tesla are now sort of in the rearview mirror, so to speak. Although some people will still want to spend that 80, 90, 100,000 on a car. The other thing I would point out is some of the plug-in electric, they've got essentially a combustion engine and a extended range, that you can recharge. Some of those now, I mean, it's commonplace that those are 70, 80, 90. Best one I've found is 125 miles, that you can go 125 miles on an electric motor, and then your petrol slash diesel engine kicks in after that, and then you run it on like a hybrid basis. So anyway, I think Luceco's got far further, and I think if anything, that £2 price is undercooking it. But what do I know? That's just my opinion. So if we look at Luceco as a part of this, so once you factor in that current share price, I mean that takes the assets of the company to £4.30 and the NAV from 360 to 375. And that's just because the share price has jumped since the end of January. So essentially, if you're picking up ESO at, like I haven't paid £1.80, so even though it's 170, 180, you'll get it below 180 because of the spreads. You'll probably get it at 176, 77, something like that. But essentially, it's either very close or virtually the case that for every share of ESO you buy, you're getting one share's worth of Luceco included, as you can see up here. You're getting £1.80. I mean, it's actually not 175. It's one. Well, I mean, let's put in the correct calculation: 179.8. And then if you pay somewhere between that price and that price, essentially you're getting it for free. So down here, growth of 6%, acceleration of growth, EV charging up 85%, profits, increase of 15%, margin likely to exceed 12%. So it's firing on all cylinders, no pun intended. And I think the whole thing of electrification as well is just another reason that Luceco will do well in the year ahead, and also potentially the recovering construction market. I mean, the UK construction couldn't get any worse, and it's now rebounding, albeit still below 50 on the PMIs, construction PMIs, but it's rebounded I think it was from 41 to 46. So quite a sharp rebound, even though it's still negative. It's rebounding from a deep nadir. Anyway, moving on to the other shares, the one that I'm particularly excited about is Pharmacy to You. Now, this I've put in the historical valuation, which was 14.8p. But what I would point out is when you actually look at the NAV, there's 55.5p that I can't ascribe to anything particularly. Part of that 55.5p will be Pharmacy to You. Now, it was historically 15p a share. It wouldn't surprise me if that valuation has at least doubled. And the reason I say that is, I mean, they describe it in the trading update as accelerated growth, which is nice to hear. But what does that mean? Well, because this is a privately listed company, you can't see the up-to-date accounts, but the historical accounts that I have seen basically point to very rapid profits growth. And what we see post-period and what we see in the world around us, I mean, hundreds and hundreds of pharmacies are closing. So 200 closed in 2024, 650 closed in 2025. Now, why did pharmacies close? Couple of reasons. As you probably know, costs are going up and up and up. Living wage, employers' NI. I mean, pharmacies have to pay those. Pharmacies have to employ expensive people. To operate as a pharmacy, you've got to have a pharmacologist, trained person, perhaps multiple trained people. And it's not just a case of putting in minimum wage people, although part of it will be minimum wage people because for essentially the pharmacist is the one that is the expensive one, and then you'll just have shop workers as the other people. But as you know, employers' NI has gone up, national living wage has gone up, rent and rates have gone up. So there's lots and lots. Heating has gone up. Lots and lots of costs that these pharmacies have got. And by and large, I describe them in this article as being of the 19th century. I mean, substantially, these pharmacies don't operate any differently than they did 20 years, 50 years, even 100 years ago. They're running very out of date models, business models. You know, there's no barcoding, there's no sort of systems. You know, they'll move little plastic. I've been to several pharmacies, but not to every pharmacy. But I think the way they generally move it around is they have these little plastic baskets, and things get checked off by several different people to make sure that, you know, you're not dispensing the wrong thing that's going to kill someone, or, you know, the wrong dosage, or, you know, all these things that I suppose, you know, it's like handling TNT, that you've got to kind of, you know, sort of handle things carefully. It's not just a case of rush, rush, rush. But to my opinion, it's the absolutely logical thing that you would want to automate. That you could automate a lot of the things that are done by human handling, and have checks in there that do the equivalent of what a pharmacist does, but use machinery to do it. And I think that's what, you know, these guys have done, invested very heavily into automated equipment. And it's also helped along by the fact that in England, NHS England, that you can get your prescription delivered through the post. Now, this isn't yet possible in NHS Scotland, Northern Ireland, or Wales. It's, you know, they're all sort of behind. But in NHS England, which dispenses 1.1 billion prescriptions, you know, there's a growing number of people that, as the number of pharmacies close, you know, hundreds and hundreds closing, that means the queues in the remaining pharmacies are growing and growing and growing. And obviously, with immigration and different things, the number of people are growing and growing and growing, and the number of elderly people that require more prescriptions are growing and growing and growing. There's lots and lots of reasons why uh, queuing up in a pharmacy is not a great thing to be doing. It's not exactly convenient. You know, pharmacies are open 9 to 5 generally, or maybe 9 to 6. So busy working people are, you know, exasperated by the experience, I think is the feedback I've heard. So, you know, offering a postal alternative is pushing on an open door. Now, Labour have introduced another reason that a lot of these pharmacies have gone bust is that prior to Labour coming to power, essentially pharmacies were just given a flat £1.20 ish per prescription they filled, and that was the end of it. They got £1.20 and they had to make it work. Well, wages were rising, you know, costs were rising. So that's why a lot of them went bust. They just weren't making any money, that they couldn't make any money. Now, Labour, with all of you know, Rachel's taxes, have dished out a load of money to pharmacies. In other words, what they've done is they've uh, increased the prescription from 127 to 146, which is great. That helps, you know, pay for the living wage, pay for the employer's NI. So the, you know, the taxes that they've taken sort of cover the cost of those taxes for pharmacies. Doesn't mean they make any more money. But when you've got large amounts of automation, when you've got large amounts of, you know, processing where you're not having to pay higher wages, or at least you're more insulated from that. That 127 to 146 just goes straight to the bottom line, which is fantastic. So that's one of the reasons I'm very excited about Pharmacy for You. The other thing I would point out is, now these are the accounts up to March last year. Just have a look at the growth rates on this thing. Prescriptions dispatched grown by 64%, patients grown by 86.6%, revenue grew by 67.6%, gross margin per prescription grew by 2.3% to 26.7. Now, that's before this price rise to £1.46. With that price rise, that gross margin now is going to be substantially higher, substantially higher. That that margin is going to be into the 30s, in my estimation. Um, EBITDA grew by more than 100%. Yeah, so lots and lots of reasons to feel very excited about the direction of travel. Now, what else have Pharmacy to You done? They've bought, so as well as sort of this whole automation, postal delivery, they've bought so a couple of years ago they bought Lloyd's Pharmacy. So not only were they delivering under the brand name of Pharmacy to You, but they were delivering under Lloyd's Direct. They also acquired a pet sort of pet prescriptions business. So worming, fleas, all of the various medicines that are now available for pets are sort of also a line of business, and obviously running through the same automation and so on from their delivery center. But what they've also done is acquired another business. Now this is the Lloyd's pharmacy business, or pharmacy online business rather. Sorry, not the pharmacy as in the retail, but this is the pharmacy online. So this is essentially a branded online GP service. So where you've got, and you'll notice, 2 million UK patients. I mean, this is not they spent over 50 million on acquisitions in the last year. And this was, I think, the lion's share of the cost of those acquisitions. But if you've got any of these conditions, challenges, hair loss, menopause, migraines, HPV, jet lag, stop smoking. I mean, yes, you can get an appointment with your local GP. You can queue up for the appointment. You can ring up for the appointment. You can do all of the things that you do to get an appointment and get it for free. But busy schedule, disappointment, maybe you don't want to talk to your GP, I don't know. But depends on various things. I suppose the idea of using an online service can be and is attractive to a growing number of people who have kind of given up on their GP for various reasons, and so I think this could this be floated one day? Absolutely, I think so. When you're able to show growth of these kinds of numbers, I mean, yes, the bottom line profit because of debt and because of the fact that they're growing so fast, the bottom line, it doesn't look fantastic particularly, but on an EBITDA basis, could that go for 300 million? 16 to 18 times EBITDA. And this is EBITDA from a year ago. It wouldn't surprise me whatsoever if this is now sort of at or approaching something like 50 million EBITDA, so 16 times that, and that starts to get quite exciting, and that the ownership level by ESO isn't massive. It's not disclosed, but they own at last valuation about 5.1 million in Pharmacy to You. So could that be worth plus 5, plus 10, plus 20, plus 30? I mean, yes. In my opinion, it's quite difficult because these valuations are historical. Um, I mean, since this point here, so obviously it's the 80% here that we're interested in. Since this point here, this was back when they were operating. Well, it wasn't even based on 2024 numbers. It was back when this was just a microcosm. So I would say part of that increase, that 55 pence that I was referring to, large chunk of it is here. In the event of an IPO or a trade sale, could a large pharmaceutical company want to take this to vertically integrate or something? Yeah, absolutely. That's another possibility. Could a large supermarket take it? Yeah, absolutely. Could Amazon take it? Yeah, absolutely. There's quite a number of ways that this could play out as a value realization, and I think in my opinion, just because they haven't had a trade sale or an IPO for a good number of years, that's not to say it can't or won't happen. It's just that the markets, as you well know, haven't been right and have been challenging. So yeah, look, that's about all I was going to say on this, other than uh, yeah, that there's quite a number of I sort of call it a sleeping giant. There's quite a number of reasons to feel excited about it, in my opinion. Rayware, so this is the one that's worth quite a lot, 87p per share. So again, if we have a look at this, Rayware, now this is 100% owned by ESO. So obviously, from the fund point of view, it's 80% owned by shareholders. 20% is owned by people who have privately bought into. So anyway, it's worth the equivalent of £1.06. I mean, what I would say is that you're getting seven brands. I mean, six last year, and there's a seventh that's been added. So, these brands are pretty, pretty high end. Pretty, if you buy stuff in House of Fraser, John Lewis, that kind of thing. Bicester Shopping Village. You're going to find these brands. They're pretty prevalent. It's gone from loss making, EBIT to loss making, to a bit to profitable in the last accounts, which were in 2024. If you actually strip out the restructuring costs, it was net profitable. It's got gross margins of about 50%. And what you kind of see, I mean, we only know that according to the trading update, that it had strong trading and sorry, let's get the exact wording. So it's this bit by here. Improving sales momentum, strong growth in its US and marketplace channels. So the sort of the translation of that is that when you look at its channel strategy and how it's marketing itself, so it's this for example, is its trade brochure to its trade partners. I mean, it's focusing in on different campaigns like Great British Bake Off and Back to Uni, Christmas Black Friday, Christmas gifting, various things that they're doing to modernize. Things like upgrading pet bowls from a cheap plastic, like my 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 dog has like an ice cream tub. uh, but one of the interesting things was my dog went off its food and basically wouldn't eat, but was sort of desperately biting me and, like, desperate for something. And I said, well, look, there's food there. Anyway, turned out that the dog had turned against its bowl. So we replaced it with a different cheap plastic um, Tupperware bowl, and it wolfed the food down, and then had a second portion and wolfed that down, and so on. So I guess the thing about pets having birthdays and sort of getting upgraded stuff. Earthenware, stoneware bowls, as you see in these little pictures, are kind of just one of the ways that I guess it's playing into this sort of upgrading kind of strategy. So I think there's quite a lot going on in the UK and abroad, where Great British Bake Off, all of a sudden we're all sort of using pickling jars and things that you know our grandparents would have used, as when we were kids, and our parents never used, but now a new generation has rediscovered pickling. And even things like these rather, I don't know, fetching butter bowls, and I don't know, butter accessories, butter churners. I mean, like, I would not be in the market for this stuff, but clearly there are people who would be, and I can sort of think of certain family relations, without casting aspersions, that would be all over this stuff and wanting it, and having it prominently on display when they do an afternoon tea with their friends, and this, that, and the other. It's kind of very much on page for kind of today's society, I think. Obviously it's all quite high end. I mean, this isn't like 99p stuff. It's going to be, but equally, it's not sort of massively high end expensive either. I was looking at it on Amazon and in here. I mean, you see it gets great reviews. They're selling, sort of 100 plus per month of this one, and I think there was one which was selling 1,000 a month, 300 a month. These are all sort of Kilner is one of their brands, so it's all sort of there's some there that are not getting such good reviews, but most of it sort of 4+ reviews, and looks looks strong for what it's aimed at. And I guess if you've got a growing propensity to upgrade your kitchen and kitchenwares and things like that. And even your pet bowl. I'm sort of laying down the the psychological thing that for the pet's next birthday, maybe you should think about getting them an earthenware pet bowl. That pet birthdays are now a thing. Like they never used to be a thing. Like I had a dog years ago, and he never had a birthday, not once. I think we kind of when he died, we were like, was he 16 years old or 15? Like it's just mental that today's world that we celebrate pet birthdays and you can get pet birthday cards. I mean, come on. Anyway, uh, just I guess the expansion and clearly there's a I mean I've looked at Rayware a year ago and I looked at Rayware today and I was quite impressed by how much more focused it is on its product range and its communication and also its Amazon presence that was nowhere to be seen a year ago. So yeah, all I've put in a little screenshot there of a couple of the Kilner jars, and I could talk about Viner's knives and other things as well. Moving on to Whittard. So Whittard's again, it's owned 100%. Now this one was bought out of administration, so it's on the books at 1 million. 3.6p a share. But I sort of like how much of this 55p missing is Whittard's, because again the revenue's up, the profits are up, um, the expansion overseas is going strong. It gets great reviews for its products. Again, it's sort of like a 4.7. It gets better reviews than Hotel Chocolat. Which kind of I suppose is the benchmark, if you like, for hot chocolate. It outdoes that. Very strong ratings, etc., etc. Profits are up. So yeah, all heading in the right direction. I think for me the real key thing here is the rebound in UK tourism. That's a reason that Whittards will do well, and secondly, its expansion overseas, and it's working with Rayware to coordinate its expansion overseas. So even though they're different businesses, they're sort of sharing channels, sharing costs, and different things. So that for me is not sort of quite as exciting in terms of its growth, but it's heading in the right direction. And again, is a very iconic British brand, 139 years old. So yeah, that's another potential IPO or acquisition one to watch. David Phillips was on the books at 12p. I was shocked to learn that it had gone bust. It's not reported, it's not mentioned in this trading update, but yeah, it closed its doors last August. Part of its business, the furniture rentals, carried on. It looks like that is being wound up this month in February 2026. Now the point is that if this is on the books at zero, and it might be, it might have gone minus 12, something else will be on the books at plus 12p. So it won't be 55p that's missing, it's 67p that's missing, as in, Rayware / Whittards / Pharmacy to You have gone up by that 67p a share. This one was always a struggler. In my last article, I described it as a potential turnaround, but in a tough market, construction's in a tough place. I kind of said, maybe they will see a rebound because of Labour's promise to build 1.5 million homes. But we all know, as I speak in February 2026, there hasn't been a rebound in housing and in the build out of new homes. So yeah, I mean, like this is one where it's gone to the wall, zero, and that's the end of it. The final one, Denzel's, again, doesn't appear to have made much progress. It's an earlier stage one. It's only 7p a share. It's kind of a small investment, minor investment. So it's it's in all the supermarkets. It's in Amazon. It's in Pets at Home. It's in Jollies. So they're doing, as far as I can see, all the right things. They've withdrawn or appear to have withdrawn from trying to sell into every pet shop, every independent pet shop. They're just focusing on large national channels, they tell us, and they've had some follow-on funding from ESO, and I think it's kind of a make or break one for the future. So yeah, look, to sum it up, the buybacks would mean that this is then on an even sharper discount. So I think when you factor in the fact that you're getting a free ride on Whittard's Pharmacy for You, Rayware, and Denzel's is fantastic. I mean, like, to get those for free when Luceco is, and even Luceco, I mean, I'm more than happy to hold Luceco. I did buy Luceco directly and then sold it off and bought ESO. So I kind of have swapped out, because I thought, well, why am I holding Luceco when I can hold it the equivalent of the amount of Luceco and get these other things included for free, just because it had jumped, the prices have relatively jumped. This one just gets overlooked, and I don't know why. I think because people see the flat, they see the flat nav that hasn't sort of grown over time, that they kind of get put off by it. But and obviously, when you read that David Phillips has gone bust, it's not doing very well. Then, well, that's just the nature of private equity, as far as I'm concerned. Some stuff will win and some stuff will go to the wall, and they when you look at the sort of doubling of Pharmacy for You, and the thing I would take from it is there's 1.1 billion prescriptions in NHS England alone, and these guys, Pharmacy for You, Pharmacy to You rather, uh, uh, grew its business from 20 million to 30 million. So in other words, from 2% to 3%. I mean, it could continue to grow that business by 50% and double its profits for the next 100 years, or I mean, maybe not 100 years, but you get what I'm saying is, and especially once NHS, Scotland, Ireland, Wales come on board, and then potentially there's, what about France? What about other countries? What about Ireland? There's potential for rinsing and repeating the same business model abroad as well, potentially. I haven't really looked at that, but that's that. There's uh, and I think, the number of prescriptions and the way that they get dealt with, I describe it as 19th century, and I think that's true. I mean, you could, in the 1800s, have visited a pharmacy, and it goes through the same sort of steps and whatever. I mean, the only thing that's different is that, there's electric lighting instead of oil lamps, and there's a digital till instead of a sort of a money box or something. I wouldn't surprise me if some of the pharmacies have got little money boxes and not tills. But anyway, being unkind. But yeah, so I think there's certainly some numerous reasons to feel that this is an interesting idea, and I think, in my opinion, the sort of to be put off by its historical flat NAV is missing the point a little bit. But there we go. That's just my opinion. Hope that's been a useful video to watch. The article will be out on theoakbloke.substack.com. If I could invite you to like and to share and so on this video, I'd really appreciate it. Thank you. Thank you for watching, and cheerio for now. Cheerio.